Welcome to the EisnerAmper Engaging Alternatives podcast series. I'm your host, Elana Margulies-Snyderman, and with me today is David Chan, Vice President at Homestead Capital, an investment manager that acquires, finances, and manages diversified portfolios of high-quality farmland assets across the United States. Founded in 2012, Homestead employs flexible equity and credit strategies with a focus on risk management and differentiated portfolio construction. Homestead seeks opportunities for value enhancement through capital improvements, tailored farm management, crop selection rotation, and economies of scale. San Francisco-based Homestead currently manages more than $1.6 billion in assets for pension plans, insurance companies, endowments, foundations, and family offices. Today, David will share his outlook for agriculture credit investing, including the greatest opportunities, challenges, and more. Before we dive into the conversation with David, don't forget to hit that like button and subscribe to EisnerAmper wherever you listen to your podcasts. And you can also find us on YouTube at EisnerAmper. Hi, David. Thank you so much for being with me today.
Thanks for having me, Elana. Excited to be here.
Absolutely, David. So to kick off the conversation, tell us a little about yourself and how you got to where you are today.
Of course. So I grew up around agriculture in New York's Hudson Valley. My first job was actually on an apple orchard, coincidentally. But I never knew I would spend my career in this sector. A lifelong interest of mine has been weather and climate, which led me to study atmospheric science in college. And when I became interested in how weather can impact certain sectors, agriculture rose to the top of the list. From there, I've worked in a variety of investment roles in agriculture and for different organizations like Barclays Investment Bank, PGIM, AmeriCapital Management, and Farm Together, before most recently joining the team at Homestead Capital.
At EisnerAmper, we are creative problem solvers that take a 360-degree approach focusing on you. We're an award-winning firm with decades of experience. EisnerAmper, let's get you ready.
David, so given your focus on ag credit investing, I would highly welcome the opportunity to hear your overall outlook for the space.
Sure. Before diving into credit specifically, I think it may make sense to share just a bit of a more general outlook on ag writ large. And so 2025, I think we would say, has been a mixed year with some really positive recovery in some key markets like almonds, but also a bit of unplanned uncertainty in others like soy, where the tariff backdrop has played a key role in introducing higher volatility. It does underscore, though, I think the resilience of the sector and the asset class, even in the wake of persistent high interest rates and large-scale shocks to the normal flow of trade from tariffs. We still have seen positive appreciation in U.S. farmland. On the income side, the U.S. market is unique to others because of two fundamental features: robust crop insurance and strong bipartisan government support. Both work in concert to smooth volatility that growers would otherwise encounter. And we think that this allows growers in the U.S. in particular to be longer term in thinking and more strategic in the way that they operate. So that was just a bit of what we're seeing in agriculture more generally through this year in the U.S. Now diving into credit more specifically, U.S. ag credit, I would say, is truly an extraordinary market. The ag credit balance sheet is north of $500 billion, and commercial banks and the farm credit system represent more than 80% of that market, each holding about a 40% share. We see increasing demand for alternative credit in agriculture because of three key reasons: conventional loan dynamics, market dynamics, and the specialization of the sector. First, on the conventional ag side, conventional ag credit qualification is very conservative and rigid, and it's unexpected to change in the near term. It would actually take an act of Congress to change these standards, which we think is unlikely. Second, the ag credit market is shrinking due to lender consolidation. So with fewer farm banks being at the avail to borrowers, despite increased lending at commercial levels, it creates, I think, a need for more alternative lenders and a greater demand for alternative solutions. Lastly, the small size of both conventional and alternative ag credit markets can be attributed to specialization. Agriculture, although it's one sector, we think of it as 36 or so mini economies, each with their own fundamentals. What's happening in the almond market can be very different than what's happening in organic apples or what's happening in corn. And so you have all these different economies and all these different fundamentals at play. And of course, they all happen to be in different geographies. Rare to find a apple orchard in, say, Illinois. You're much more likely to find one in Washington state. And so this specialization really serves as a natural market barrier. And we expect this trend to persist.
And David, more specifically, what are some of the greatest opportunities you see in your space and why?
We see credit opportunities across the capital stack, but we see a uniquely impactful opportunity in transitional loans or bridge loans. So these are loans that are essentially solving a problem for a borrower for a short to medium period of time. The rates on these loans are often higher than what you would expect for a conventional loan, but there's also increased risk and increased benefit to the borrower. The benefit to the borrower is these are often covenant light loans. The increased risk is that the borrower might have an LTV of, say, 60% as opposed to 40%, which would qualify for conventional. So those are a bit of the dynamics of these types of loans. What we see, and there's multiple use cases for borrowers who could benefit from a transitional loan. Sometimes there are farmers who have over a century of performance history. They could literally show you yields over a century, which is pretty astounding. But because of the rigidity of conventional loan standards, they may have breached a covenant in a conventional loan, like, again, the example we just shared, going north of a 50% loan to value or LTV threshold due to market dynamics. And we do not view these borrowers as distressed counterparties. They're generally not distressed counterparties, and they do not have solvency issues. They have liquidity issues. And so a covenant light transitional loan that bridges them back to a conventional loan in time can be a very powerful solution. Another use case may be a farmer who is looking to make a strategic acquisition. Actually, a fun fact, in the US, the average age of the grower is approaching 60. So we do expect to see a lot more land trading hands. The USDA expects as much as 50% of all farmland to trade hands over the next couple of decades. And a farmer may want to bolt on a neighboring parcel that's never been available for sale, but may not have the cash on hand required for a high deposit, say an 80% deposit on that new acquisition. A transitional loan can help them execute on the strategic acquisition and be on a path to get back to a conventional loan profile over time. So we see these transitional loans that solve a variety of problems for borrowers as the greatest opportunity in the market right now.
David, on the other hand, what are some of the greatest challenges you face in your space and why?
That's a good question. I would say probably some of the greatest challenges that we see, the barrier to ag credit is high because of the expertise it requires. And I would say this is, the highest challenge, greatest challenge that we see. Again, going back to 36 mini economies, essentially, each commodity group, each geography requires a nuanced view of how that collateral should be valued. And so it can be very daunting for alternative credit lenders to come into the space and provide credit knowing that, they will need to either in-house develop an expertise or outsource an expertise to understand how to accurately value that collateral. I would say this then leads to another challenge, which is a lack of data. And so I would say today, because of how nuanced and niche ag credit is, it is a fairly opaque market. There is not a robust data set or data universe out there where thousands or tens of thousands or millions of loan characteristics and rates and performance can be reviewed, as you may find in other asset-backed lending opportunities in more conventional real assets, let's say, residential real estate. And so that opacity, it can be again a barrier to lenders who would otherwise be thrilled to lend to these creditworthy borrowers, but may not have the ability to underwrite. And again, that can come down to difficulty in valuing collateral, or just difficulty in acquiring the expertise needed to do so, or the lack of data that exists today.
David, we've covered a lot of ground today and wanted to see if you have any final thoughts you would like to share with us.
Sure. I think, one final thought that I would maybe leave is just, sort of the importance of agriculture here in the US. I think it's a sector that often is taken for granted and many forget about. I think, in recent memory, and just anecdotally from, my friends and family, I think ag really was in the spotlight during the pandemic when, many of us were going to our grocery stores or ordering delivery and seeing that, there was a lack of fresh produce available, or you couldn't buy tomatoes, or just regular items on your grocery list that you expect will always be on the shelf at the grocery store. And during that period, I think we realized the fragility of our food system. And I think one thing that is always surprising to us is agriculture is such a key component of the U.S. economy. It's actually 5.5% of U.S. GDP, but it is nowhere near represented to that level in typical investment portfolios, despite its attractive characteristics of uncorrelated returns and being a natural hedge to both inflation and stagflation. And so, I think the lasting thought that we would share is, agriculture continues to be an underinvested space, but we think that there's tremendous opportunity in the sector, and it's one that we know is vital, should not be taken for granted. And at the end of the day, we would argue is pretty close to perfectly inelastic, because people always have to eat.
David, I wanted to thank you so much for sharing your perspective with our listeners.
Thanks so much for having me, Elana.
And thank you for listening to the EisnerAmper podcast series. Visit EisnerAmper.com for more information on this and a host of other topics. And join us for our next EisnerAmper podcast when we get down to business.